Yeah, well, at Eaton Vance, we pride ourselves on being contrarian investors, where we're looking for value that has been mispriced by the market. And it's so easy to tell the bear case right now on the market overall and on financials in particular. Trade is causing fears of recession, which is causing interest rates to fall. Banks make money by borrowing short and lending long, which is harder to do when the yield curve is inverted. But if you take the view that at some point that will change, at some point these problems will sort themselves out, then there's very good value. These stocks are trading as cheap as they have in a long time versus the broader market. And so if you're a little bit patient and willing to look out beyond the immediate horizon, I think there's very good value in the financial sector.
Bill, like Eddie, you like industrials, but financials are not on your list of faves right now. Consumer discretionary stocks are. Why not financials? Answer Eddie, and why consumer?
Well, I think one thing is you're right. You got two kind of contrarians here. I just say it's a matter of kind of putting them in order that we like, but I don't necessarily disagree with them. I think the time is right to lean against kind of the consensus a little bit. There's plenty of reasons to worry about things, but there's, I think, good reason to look beyond that. We see things look a little brighter, and that's what feeds into, the more cyclical areas that both he and I are talking about. I think one is you're seeing the global central banks step in with easing. It takes a while for that to show up. I suspect they'll help out his financials. I certainly suspect they'll help out the consumer discretionary and the industrials as well.
When you say, Bill, that when you look out a little farther, things look brighter to you, it is hard, isn't it, though, to look past some of the things that we were just talking about in the preceding segment. India and Kashmir, Iran, Hong Kong, the trouble in Italy with the government there, now Argentina, the possibility of no trade deal, Brexit. There's a lot of stumbling blocks out there.
Yeah, I mean, and the issue is the market has to eventually price in all the uncertainty. But as we know, really what ends up leading to opportunities is once you get all that priced in. Secondly, once investor sentiment gets negative enough, we've already seen a lot of negative sentiment. I'd say the last piece of the puzzle, which I think people kind of lose track of, is there is a lot of dry powder out of there wanting to buy, and certainly bonds, yields are falling away. So they're going to be looking for some sort of return. Money market assets at over $3.3 trillion. We haven't seen those kind of numbers since the financial crisis. If, in fact, there's any sort of as a glimmer of good news, I think you could see a really nice move.
Eddie, tie it off here with a final thought.
I think the one risk out there that does worry me from that long list is Hong Kong, because that could find if the military steps in there, if it gets bloody, I think that could infect trade talks and impact trade talks, and that would be a concern, because a lot of the weakness we're seeing in the economy around the world is self-inflicted as a result of this trade standoff. Once that's resolved, I think you want to go back to the cyclicals, and that's why financials, industrials, consumer discretionary are the place to be, but you got to be willing to buy them before everybody else does when they're cheap, which is now.